Thing number two, we're moving on to the Bank of Japan, BOJ, the ineffective intervention of the Bank of Japan.
We've been speaking and writing about the issues in Japan for a year and a half. And fortunately, more people now are starting to discover this. They're starting to realize it's a problem. I'm actually really glad that other people are starting to catch up with where we were and realize this is a giant problem. So the big problem with the issues in Japan is they ran up an enormous amount of debt. Their debt to GDP is 260%. Generally above 100%, people start to get concerned. At 260%, they have a giant problem. And the reason that the Bank of Japan was able to do this is because they set interest rates at negative. They kept their version of the Fed funds rate at a negative number for something like 9 years. And then, as we reported here in the five things last month, the Bank of Japan said, okay, we're going to positive, except they set the reference rate at between 0 and 10 basis points. So, they went positive, but at the midpoint, that's 0.05%, and that's not really meaningful. So the issue with having your interest rates so low is people don't want to hold your currency. You want to hold a currency where you can at least earn a decent rate of interest. And so as the US Federal Reserve, the Bank of England, the ECB, the European Central Bank have all raised rates, Japan has lagged, and that's caused the yen to fall. And the yen in the last couple of years has gone from about 102 to the dollar to a week ago, it was approaching 160 to the dollar. This is a massive currency devaluation, and the currency markets moving 2 or 3% is a big deal. These guys let their currency fall almost 60% against the dollar. This is a gigantic problem. So Japan has a substantial amount of foreign currency reserves. And what they did was on Monday, they spent, yeah, there it is, a $38 billion in their foreign currency reserves defending the yen. Basically, they were selling US Treasury bonds, using the proceeds of that in dollars to selling dollars basically to buy the yen. And that that rose the value of the yen that caused the value of the yen to increase from about 160 to the dollar to about 155. And the problem was because they didn't change any of the structural issues behind this, you end up in a situation where the market says, okay, well, if you're done intervening, we're now going to take the yen back to where it was. And literally like a day or two later, it was back at 158. And so, all of this intervention bought the yen, 1 or 2 yen per dollar, a meaningless amount. So they went back and they spent another $24 billion, and they caused the yen to rise again right around 152, 153 to the dollar. And guess what happened? By the next day, they were heading back down, right back down to where they were. And the problem with the approach that the Bank of Japan is taking is they're not changing the structural issues behind it. They're just spending money to support their currency on a temporary basis. Now, what ended up bailing them out was the Federal Reserve tapering quantitative tightening, which we just spoke about. And then also on Friday, we got a weak employment report that caused people to think that the Federal Reserve might be closer to pivoting toward lower rates than they had been before. And so that's basically what's happened there. But the Bank of Japan, at some point, this strategy, they're going to run out of foreign exchange reserves. They still have plenty, but this is not a strategy. They need to change the structural issue that's causing the problem.
So they had these two interventions, Gary. 159 to 155, and then went back down again, back to 158, right? So it seemed like the net was essentially nothing happened, more or less. What would cause this to actually be a positive outcome for the yen, if any, or what would that market scenario look like if these interventions were to actually take hold or actually do something to improve the value of the yen?
There are two options that are possible here. Sorry, there are three. One is they could do nothing and watch their currency continue to slide. I don't think that the Bank of Japan has it in them to do that. That's going to create hardship for their people. Again, nobody likes inflation, and another way of describing inflation is to say the purchasing power of your currency is declining. And that's where the Japanese people are right now. A second option is that they raise interest rates, and that would cause the yen to rise. The problem with that approach, if you're the Bank of Japan, is if you raise interest rates, and your debt to GDP is 260%, you end up with a budgetary problem, right? Here in the US, we've been talking about heading for something like $1.6 trillion of interest expense, and it's pushing out other spending and causing more debt issuance. That's where Japan would be. And so the only thing they're going to be able to do to pay the higher interest on their debt if they raise rates is going to be to print more yen to pay the debt, and printing more yen leads to more inflation. And again, this is why we call it a debt death spiral. That's how we've been referring to it. The final option, and this is the reason why the yen rose on Friday, is because with a weak employment print in the US, what Japan is really hoping for is a weaker economy here in the US that would cause the Federal Reserve to lower interest rates. That would reduce the spread between people holding Japanese government bonds and people holding US Treasury bonds. That spread is the difference between the interest rates, which right now is in the neighborhood of 400, 500 basis points, which is a lot, 4 or 5%. And so if that were to happen, Japan would be bailed out of this problem. And, in the US, we'd be facing higher inflation, but they'd have a stronger currency.
Great stuff. Great analysis there, Gary.